inflation is quite a significant focus of ours at the moment, and what we're looking for in our equity allocation is basically to be able to take exposure to inflation without it costing us too much. And there's two ways that I think really stand out in terms of the way we can do that at the moment. One is within supermarkets, and one is in commodities. So supermarkets is a really interesting one, and that's the one that's probably been at play for the longest period of time in our portfolio. If you think back to the last crisis pre-pandemic, it was bushfires. So one of the sort of obvious implications of bushfires was a change to agriculture in Australia. And we started to see the first signs of food price inflation. And that comes through in the supermarket sector. So as food prices go up, it helps revenues and you get operating leverage, and your supermarket business starts to benefit. So that's been a core exposure within our Australian equities allocation for some time now. And that was just accentuated as we went through the pandemic. There was another shift. People had to change where they basically demanded their basic food and sustenance from. It could no longer be restaurants. It had to be through supermarkets. And again, that's enabled the supermarkets to increase prices further. I mean, we've all been on the receiving end of plenty of catalogues from supermarkets offering price reductions, and they're not there anymore. So it's a really obvious example of pricing power. Commodities are a little bit different. So in Australia, the large commodity exposure is basically through iron ore, particularly in the listed space. So iron ore's had two exposures to inflation, one on the demand side. So, when the pandemic began to unfold, people think back to how did we solve the last crisis? Well, the pandemic unfolded in China, and how did China solve the last crisis? They stimulated, and that increased iron ore demand. So that's the first place we see the price response. Then the next bit, it comes in on the supply side. So price rises consistent with expectations, and then it stays there. And what was at play there was supply disruption in Brazil, basically as a result of COVID. They were no longer able to maintain the same level of output. And that benefited Australian companies who mine here and were able to maintain their level of output through this period. They really haven't been impacted significantly, no significant mine shutdowns over the last 6 months, which has seen them being able to deliver significant amounts of iron ore in a rising price environment, which has been very favourable for our miners. The way we like to approach portfolio construction is through diversification. So what catches our eye is when we can put a good basket together, and both these sectors allow us to do that. So we will hold a position in both Coles and Woolworths. From our point of view, these are both quality companies. They have robust balance sheets. They show signs of improving ROAs, decreasing leverage, and we'll own both. Now, I guess what's maybe a little bit unique is we will start to push that quality a little bit, and we'll incorporate Metcash in there as well. So we've taken that parcel of essentially 3 companies, and we think that gives us the best exposure to the thematic we're looking for here, which is rising prices through supermarkets. And what do you get out of holding Metcash in there? Well, you get more exposure to convenience, which you don't get as much of in the majors. Mining, we approach a similar way. I guess one of the changes we've made in our portfolio, though, is while we do still hold a basket of essentially the 3 major iron ore producers, BHP, Rio and Fortescue, we've started to increase our weight to Fortescue. So it's a interesting company at the moment. It's got one of the highest dividend yields across the market. And yields are always tempting, but you know, you've got to be careful that they're not a value trap. But when you've got, you know, supply constraints, a solid source of demand, you have a little bit more confidence in Fortescue being able to deliver that yield to you. So we've shifted our portfolio a little bit over the last few weeks, out of BHP, out of Rio, and a greater weight in Fortescue. Now, what's most unique about our process, I think, is the way we embrace optionality into these positions. So if we go back 12 months, it was very expensive, at least on a relative basis, to buy protection, buy something like a put option on the listed miners. They tended to have the highest volatility and the highest cost to protect. But over the last 6 months, that's switched. They're actually now offering, it's still expensive, but relative to other companies like the banks, it's become cheaper to protect on the iron ore miners than other names. So we can actually own a company like Fortescue at the moment, buy a put, and so protect against that being a dividend trap. Supply in Brazil comes back quicker than expected. There's an adverse outcome in China-Australia relations and sees that demand disappear far quicker than anticipated, which impacts the Fortescue price. The cost for that protection is not expensive at the moment, particularly compared to that dividend yield. It's basically double digit.